Hey, what's up, guys? It's Jonathan here. Wow, what a busy day today was. And man, we got quite a bit we got to talk about. Um, I know this is a pretty late stream, but let's just try to get through this and we could kind of get to the other side. The two biggest things I wanted to talk about was the first thing I wanted to talk about was the ADP job report that we got. And um, So let's get right into that. The eight okay, let's start this off right. Make sure everything is good to go. Yes. Okay. Hey, what's up, guys? It's Jonathan here. So we just got the ADP employment report numbers today for the month of November, and it seems like Santa came early this year. But let's get into the details of this and kind of break this whole report down. So, to give you some background on this, this is a report of private sector employment that ADP has access to. So, for those of you who don't know, ADP, they're a payroll processing company. They usually work with bigger firms, but they also work with smaller firms as well. And they aggregate a lot of the data that they they're purview to. So a lot of these companies, when they let people go or they increase wages and stuff like that, ADP has access to all the data. And usually it comes out a couple of days before we get the official data from the government, which is called a JOLTS report. We did cover last month's JOLTS report, and I do plan to cover the one that's going to come out on Friday, I believe. So stay tuned for that. And most of the time, this employment report is on par with that report, but that's not always the case. So we're gonna have to see what kind of numbers we get on Friday. But anyways, let's just focus on this report for now. So the top line number was that the private sector added about 127,000 jobs in November, which was the slowest growth that we've seen for jobs month over month since January of 2021, and the estimates were about 200,000 for this month. So this is a good sign to see these numbers down from the estimates that we had. So in the when it comes to annual pay, it's currently up about 7.6% year over year. Um, but we'll go into details about that and break down those numbers even more later on. So ADP did state that the Fed's tightening is starting to have an effect on job creation and pay increases, which is a good sign because that signals that we probably don't have a wage price spiral on hand. We've had many different indicators that has shown that we probably don't have that, but it's always good to get more and more indications of that, because if we did have a wage price spiral on our hands, then we would have a Fed that would be very nasty and very aggressive, kind of like they've been for most of this year, but even worse, probably. So breaking down the data, it seems like in the in goods in good producing industries, we lost about 86,000 jobs, and this was headlined by manufacturing, which lost about 100,000 jobs, and construction that lost about 2K jobs. So when it comes to manufacturing, this isn't really any surprise. We are starting to see people spend less money on things and starting to move their spending more to services. So manufacturing, I'm not too surprised about. It's kind of in line with what we saw with the JOLTS report earlier this month as well. Construction, I do expect these these declines to grow as we start to see more and more pain to the real estate market. One of the things you gotta realize about real estate is that a lot of the pain, it takes a while for the pain to bake into the real estate market, especially since most of this pain is coming from higher interest rates. Now, we have seen the 10-year treasury decline over the past couple of weeks. I believe right now it's around 3.6%, and I believe its all-time high was around four and a quarter. So it is a pretty substantial decline, but it still will cause some pain to the it will still cause pain to the real estate market in the long term. So moving on to service producing goods, we actually saw a gain of about 213,000 jobs, and that was headlined by leisure and hospitality, which had a gain of about 224,000 jobs. Again, very similar trend to what we saw in the JOLTS report from last month. When it comes to another sector that also headlined the service producing job gains was trade, transportation, and utilities, which gained about 62,000 jobs this month, which again very similar to what we saw with the JOLTS report. As well as we saw a decline of 77,000 professional and business services jobs and 34,000 financial activities jobs as well. Again, very in line with the trends that we saw from the last JOLTS report. So breaking it down by business sizes, most of the layoff came from both small and large firms. And generally speaking, most professional and business services firms are usually smaller firms. These are kind of like you can almost kind of put them in the category of like accountants and like lawyers, engineers, that kind of space. So it's usually companies, because with those professions you usually don't get increased profit through scale. Usually usually those businesses are usually served for very small for very small headcount, and they don't really get the economy of scales that you would get in like maybe manufacturing, which would be more of a larger firm. Most of the job gains did come from mid-sized firms. So typically, this usually encompasses restaurants and a lot of like leisure and hospitality type businesses. So it does make sense that we saw the job gains with the mid-sized firms. And also, these mid-sized firms usually have a lot of part-time employees, so their headcount tends to be higher naturally because they're operating for like 12, 15 hours a day, and they're operating with part-time employees for the most part. So some of the interesting data I saw on the report is that they actually did a comparison of people who stayed at their job versus people who changed their jobs and the corresponding pay increases. So for people who stayed at their job, their pay went up about 7.6% year over year, whereas the people who changed their jobs almost doubled that at 15.1% increase year over year. And I think that this goes to show you, kind of from a personal finance perspective, how important it is for you to change your jobs every so often. Because if you don't, you usually get left behind on the pay scale. So that's something good to keep in mind. Some other interesting data I saw was that by industry, pay in leisure and hospitality is up about 10.8% year over year, which makes sense because there is more demand for workers in that field. So, of course, the wages would go up accordingly. But when you look at construction, professional and business services, and other service industries, um, we only see an increase of 6.8% year over year, which is, again, in line with the job growth because we did actually see a reduction of job growth in those industries. So to conclude, these trends that we're seeing in this ADP job report is very in line with what we saw from the October JOLTS report. Um, we will begin, like I said, we will begin those JOLTS reports for November on Friday, and that will really be. And like I said, this sometimes is in line with the JOLTS report. So if we do get a good JOLTS report, that could be a really good case for the Federal Reserve to slow down their aggressiveness, or I should say the FOMC, to slow down their aggressiveness and to kind of um, stay in the restrictive mode, but not necessarily relax yet. Um, so really, so that's pretty much all I have for you guys. Thank you so much for watching, and I'll see you in the next video. Peace. Okay, so that was the first video there. Um, let's see here. I don't think there's any questions or any comments. So, I'm going to cheat a little bit here. Okay, so let's move on to the next topic that we have here. So, um, head of, okay, so let's get this started properly. Hey everyone, it's Jonathan here. So, head of the Federal Reserve, head of the, jeez. Hey, what's up, guys? It's Jonathan here. Head of the, I forgot Jay Powell's title. This is terrible. Um, hey, what's up, guys? It's Jonathan here. Chair of the Hey, what's up, guys? It's Jonathan here. Chair of the Federal Reserve, Jerome Powell, talked at the Brookings Institute this afternoon, and he provided a progress report on the FOMC's progress to reach their inflation target of 2% in the long term. And I just wanted to give a quick summary about what was said at this meeting, and also talk about some of the implications of what he did say, and add some um, add some highlights to it. So let's get right into it. So he started off with the same old story that inflation is way too high and it's reducing consumers' purchasing power, and that price stability is very important for the overall health of the economy. It's kind of the same stuff we've heard him say pretty much all of 2022. So nothing really new there. But he did start to go into this conversation about how the Federal Reserve is really focused on looking at PCE. As we all know, PCE is the Fed's preferred interest rate measuring stick, not necessarily the CPI, which is what you usually see headlined in a lot of newspapers. And the 12-month PCE right now currently sits about 6%. And Jay Powell did go on to state how a move how a move down in the PCE over the past couple months have been followed up by a move up, and that's kind of been a recurring trend we have seen when it comes to this data, and it is making the Fed uncomfortable with inflation actually coming down, just because we keep seeing this. Okay, it's going down and then reversal back up. So it does stress the importance of the reading that we get in December, because we did see a soft reading in November, so it's really important that we see another soft reading in December. Um, and then he went on to state how core PCE gives the best outlook of inflation trajectory, and how it's moved sideways throughout most of 2020, how it's moved sideways throughout most of 2022. Now, when it comes to core PCE being the best measure to gauge inflation, I actually do agree with him to some degree, because the CPI is very influenced by it's influenced by a million different things. One of the big things that a lot of people like to talk about is how items will be substituted on the CPI, which makes it very hard to use it as a measure of consistent what do you call it, consistent price fluctuations. Because a lot of times what they'll do is, like, maybe like for beef they'll switch out steak for ground beef, which obviously those two things have much different per pound prices. um Whereas a PC, that isn't really done to that degree. Another thing about PC as well is that it's less affected by consumers' spending habits and consumers' purchasing power. Now, that kind of doesn't make sense, because obviously consumers' purchasing power is affected by inflation, but it does kind of remove a lot of the ambiguity that does come with using numbers from consumers and consumers' activities, because there's a million different things that could affect consumer activities. But anyways, um, when so J. Powell moved on and stated, when will inflation come down? And he talked about a lot of the forecasts that the Fed comes up with, and also other forecasters like banks and other economists. And he said that a lot of these forecasts are betting that inflation will come down significantly in 2023. And he went on to state, um, jeez, freaking spam. Anyways, okay, sorry, I was getting some spam there. Um, anyways, what I was saying is that the forecasts right now currently show that inflation will come substantially down in 2023. Um, but these same forecasters have also predicted that inflation will come down all of 2022. So basically, Jay Powell made the statement that like these forecasts can't really be trusted. Um, so he said that the Federal Reserve is really looking more at macroeconomic factors that will bring down inflation. So um, he went on to talk about the free. He went on to talk about that there's uncertainty in the terminal rate. That is the rate that the Federal Reserve will hike to and then stop hiking and kind of just sit in that restrictive zone. He did say that it needs to be somewhat higher than what was estimated on the September state summary of economic projections, and that had the terminal rate to be somewhere in 2023 at 4.6%. So my thinking is that we're probably going to be somewhere. In my opinion, we're probably going to be like at the 5% region. And that would pretty much play into my prediction that I think we're going to get a 50 basis point hike in December. Then we're going to get a 20 basis point hike in February, and then another 20 basis point hike in March. And then we'll stop the rate hikes. Um, but we will see, because we will get another statement of economic projections in the December meeting. So that will be something very important to look at as well. Um, So he did move on and talk about how GDP growth is projected to be flat for this year. He did state that this growth will need to remain very slow for us to get inflation down, and that 2022 GDP hasn't really helped with inflation, mostly because we have seen some strength in the GDP reading, especially for the fourth quarter. So Um, reverting back to what he was talking about, the Fed looking at macroeconomic factors, he kind of broke it down into three sections. So the first section is core goods inflation, which pretty much is just goods inflations of everything except food and energy. And he talked about how this inflation was fueled mostly by the reopening and by the tightness of the supply chains, but the supply chains are starting to ease at the moment. Um, Now, a lot of people, give the Federal Reserve a lot of flack for like, oh, why are they considering core inflation when food and energy are such an important part of inflation that people are experiencing on a day-to-day basis? And I think you can't really think about it like that, because you have to think that the Federal Reserve is looking at the economy as a whole. They're not just looking at what's going on with consumers. They're looking at they want to use the inflation readings, the PCE and the CPI readings, to see how inflation is moving. And the problem is when you have food and energy that are constantly doing this, it makes it really difficult for you to get a gauge on how inflation is actually moving. And because those sectors are so volatile, so that's why the Fed is focusing on the core numbers instead of the headline numbers. Just something I thought I should add. Um, the second s- um, the second type of inflation that the Federal Reserve is looking at is housing service inflation, and this is pretty much the inflation of rents and owner equivalent rents. And for the year, it's up about 7.1%. And Jay Powell did state that this is a very long lagging indicator because we have to wait for rental renewals to actually get the inflation reading that we need from it. That to get the actual numbers, like think about it. If you're renting a place for $100 a month, and and rent inflation goes up, let's just say 20%. Well, that tenant is locked into that contract for a year. So you have to wait until that year is over before you can raise the rent 20% to meet up with the market numbers. So he did predict that this will most likely last into next year because of this massive lag. But he did also state that new lease inflation has been falling since the summer. And at one point it was up 20%, but we have seen a lot of softness in that. So it's kind of a good news that we are seeing the new leases. So like people who move to a new place and they're not renewing their lease, we're seeing those leases start. We're seeing the inflation of those leases start to come down. But people who are yet to renew, who haven't renewed during this kind of inflationary environment, and who will renew next year, those are the people. Those that can continue putting pressure on this inflationary reading. Then the last important inflationary reading that he brought up was inflation in core services excluding housing. So essentially, this is the services outside of, again, food and energy. Um, it is the largest of the three categories as it makes up over 50% of core PCE. And he said that this inflation is mostly driven by wages because that's really what we've seen. Like I said, the goods are not necessarily what's driving it. It's more of the wages now that are driving a lot of a good amount of the inflation that we are seeing, and that's mostly because there's larger demand for workers than there is supply of people who are willing to work. So the Fed is looking to balance the labor market in services, and Jay Powell believes that the shortfall will most likely last a while, mostly because it's caused by a low population rate, a, a low population rate, and a lower labor participation rate as well. Some of this also be due to the effects of COVID in terms of people who passed away during COVID and some people who are still struggling with long COVID symptoms. So, one of the trends they are seeing when it comes to the labor force is that people who are working age their participation rate is starting to go back to normal levels, like pre-pandemic levels. But there was a mass exodus from the labor force due to retirees. And it was more than just people who were aging out of the market. It had to also do with it was more than just people aging out. It was also people who just prematurely retired. Some because of COVID health concerns. Some because the stock market performed so well in 2020 and 2021 that actually gave them the opportunity to retire. And this accounts for about 2 million of the 3 million shortfall in workers that we have. And there's not enough retirees returning back to the labor force to fill in the gaps in the market, which obviously makes sense. If you have the financial means to retire, most likely you probably wouldn't go back to working. But um, There's also another thing that Jay Powell did mention was that there is a slower growth in working age population. And this is caused by a couple of things, like I said, COVID related issues, also the reduced net immigration that that we have realized in the United States for the short while now, and that's accounting for about 1.5 million missing workers in the workforce. Put quotes around missing. Um, he did go on and state that the unemployment rate right now is at 3.7%, which is some of the lowest rates that we've seen in over the past 50 years. There's about 4 million more job openings than there are workers available and willing to work. And that leads to about 1.7 openings per worker. Now, this is better than the number that we were at a couple months ago. I believe we're at a 2 jobs for every one person who wanted to work ratio earlier this year. So this is leading to a slowdown in wage inflation. Now, um, and I'll say to add to that, like if you're somebody who's young and you are looking for work, or you're looking to increase your marketplace value, this should be very exciting to you, because now you have an opportunity to significantly increase your income. Because think about it, there's a missing gap of workers, so there's a need for workers. um I mean, I even see it in white collar professions as well. Like where I work now, I would say about 30 to 40% of our engineering positions are vacant. And I talk with hiring managers all the time, and they tell me how hard it is just to get people to even apply for the job, let alone to even see if they're qualified. So I mean, like if you're a young person and you are really driven and you're willing to learn, I know engineering, you have to go to school, you have to get a degree. I understand that. But there are so many other career paths that you could go where there is need for your services if you are willing to learn those skills. So this should be very exciting for you. But anyways, going back to what J Powell said, um, you kind of just summarized saying that to get back to 2% inflation over the long term, we need to see the growth in GDP that's currently running well below longer term trends. We need that slow growth to continue. We need to see supply chains relax much more. We are seeing them relax now, but we need to see that continue. And we need to see we need to see inflation start to loosen up a bit as well. And we do need to see the labor market get back into balance between supply and demand of labor. Now, he did also state that, and this is a little bit, this is something we have been hearing from the Fed recently, but he did state that the full effects of tightening have yet to be fully felt in the economy, and the FOMC will moderate the pace of increases at this point to avoid over tightening, which is a very different stance than we've heard from Jay Powell, even from the last FOMC press conference. So this is a good sign that we most likely will see a softer rate hike in December. Cough, cough, 50 BP, like I said before. Um, but we will have but in my opinion, that will be dependent on what we see with the December CPI readings and the numbers that we get in December before the FOMC meeting. So they moved on to a Q&A session. When Jay Powell was at, and there was a couple interesting questions there. A lot of them were repetitive, which was really annoying. But anyways, one of the questions I was asked was wage inflation was asked was does what does wage inflation need to be at to get 2% inflation, to get to 2% inflation in the long term? Um, he Jay Powell responded by saying that he thinks that inflation wasn't caused by wages. It was just a symptom of inflation, and that the actual inflation was caused by the bottleneck in supply chains and the increase and the demand shock from the market. So he said that wage growth needs to slow down about 1.5 to 2% to get to kind of be in line with the 2% inflation goal that the Federal Reserve has. And he did state, again, he stated the importance of getting inflation under control first and then worrying about having a strong labor market drive up wages, which will increase real wages for workers. Because the way he stated it was that if we have high inflation and then we have high wages, the real increase of those wages could actually be zero, if not negative, which we are sort of seeing right now. Um, so he they went on and they asked him about his statement about forecasts not being very accurate or not being a good use of measure to determine what do you call it, to determine where inflation will go in the future. So he pretty much stated that it's hard to forecast the supply side issues with the economy, and that's what's making a lot of these forecasts very you can almost say worthless or just not very accurate. And he said that the macroeconomics is more important than the forecast, which I honestly agree with him about. Anyone can make a forecast about anything, um, but really it's the macroeconomics that are really going to determine what happens with inflation in the long term. And he did again discuss the lag of the policy actions that the Federal Reserve is taking, and that slowing down would be appropriate at this time, given that the macroeconomic factors are starting to show that the tightening efforts are working. So he was asked about how to determine neutral and terminal rates, and his response was basically that the FOMC looks at levels of tightening in financial conditions, and how tightening affects the economy. So generally speaking, how it used to be was that the Federal Reserve will act, and because the Federal Reserve act, the economy will respond. But now markets will respond, and then the economy will respond. But now the way it works is that the market anticipates the Federal Reserve actions, and from that, the Federal Reserve then acts. So that's why we've seen the Federal Reserve, what they'll do is that, let's say the market believes that they're going to do a 75 basis point hike. So what the Federal Reserve will do is they'll come out and they'll do a 75 basis point hike, even though they may have planned to only do a 50 basis point hike. The reason why is because that's what the market is expecting. So really, they look more at what the market expects. They don't necessarily have to decide what they're going to do per se, which is really interesting to think about it like that. Just kind of how like the technology age has changed the way we disseminate information and how even economics work. But he also did say that they do look at treasury yields and credit spreads to kind of get an idea of what the market sentiment is when it comes to what they're going to do with rates. And obviously, like I said, I did say in my last video was that we are starting to see a collapse of the 10-year treasury yield. I believe it was at 1.425%. Now we're at about 3.6%. So significant collapse in those numbers. Um, he was asked about if he believes that there's still a path for soft fish landing. He said yes, he believes so. He believes that employment will have to go up a bit, but that our job market is so strong that um, we can take that that increase on unemployment, and still get inflation down to the 2% target. Um, he has been, pretty much everyone at the Fed has pretty much been saying this forever. And it seems like with the way inflation is going, there may be a good chance that we actually get the soft landing. But we'll have to kind of see what happens with the more recent inflation numbers. So he was asked about the 2% inflation target and if there is any wiggle room to change that. He said that this is a target for 2025 to 2026. And he did state that it is important that the FOMC does see this goal out, and that he added that that he it wouldn't be prudent of them to soften up too early because that may lead to the undoing of all of the work that they've done to get inflation down. He also did add that if looking back on things, he wished that he had started lifting that he had started liftoff of rates much sooner than he did, and that he was more aggressive about the liftoff of rates. I think at this point everyone kind of agrees with that. I know there's a lot of people on Wall Street and a lot of economists who are really pushing for Jay Powell to stop um, the monetary the QE that he was conducting still, and to just get to QT as quickly as possible given how rapid we saw inflation become in such a short amount of time. So moving on, he was asked about risk management considerations in terms of over tightening. And he restated that the Fed doesn't want to make the mistake of over tightening and that they want to go slower and be restrictive for longer. So they want to slow down the rate increases and they want to get to a restricted level and stay there for a while inflation starts to collapse. This is pretty much, I feel like at this point, the market is pretty much on board with that line of thinking. So it was a very interesting question. Um, Then he was asked, does the Fed think that the labor participation rate would need to return to pre COVID levels? And how much would need to be done to restrict labor demand and restore balance? So, when it comes to labor force participation, pretty much he talked about the 2000s as a whole and how we've seen labor force participation pretty much be flat. And we saw an uptick during 2020, but not really much of one. And he did state that it's not reasonable for us to try to aim to get back to pre-COVID levels, but it could definitely happen just through natural mechanisms of economics. Um, and he also did add that the balancing would need to come from the demand side for now because he's not he doesn't believe, because obviously the Federal Reserve, they constantly will state we don't have any control over um, the supply side. Obviously when it comes to labor, the supply side really comes from increased net immigration and population growth, so birth rates, and obviously those are fiscal policies. Those are policies that Congress can make happen. And to give some examples, so like when it comes to birth rate, the Congress can give more tax incentives for people who have families, which is a great way to kind of encourage people to have children. And then when it comes to immigration, obviously that is something that is controlled by the legislative side of the government. So pretty much he said that the Fed really just has to focus on more of demand destruction when it comes to the labor market. But that was pretty much it. Thank you guys. So pretty much overall, it seems like we really are dependent on what we see with the December numbers, especially when it comes to the JOLTS report, the CPI report. I don't know if we get the PCE before the FOMC meeting, but if we do, that will be an important report to watch out for as well. And our hope is that we do get something that's very palatable, and we don't get like another another deflection to upside, and we do start to see the trend of decrease in inflation continue. So I thank you guys so much for watching. I'll see you in the next video. Peace. Hey, what's up, Amit? All right, so I have been on here forever. It is now almost midnight, and I'm gonna go to bed. So thank you guys so much for watching, and I'll see you in the next live stream. Peace.